Understanding market liquidity for dummies. First candle we have is the 1 day. That is a terrible one. 1 day time frame, liquidity is right here and right here. It's called previous day high. Liquidity is at the lowest point of the wick, not the body. The wick, previous day low. Now, why is liquidity right here? Why is liquidity right here? Down here, people want to sell probably. If this breaks, people want to be able to get in quick, so they set an order for it to automatically trigger so they don't have to trigger it themselves. Up here, same way. People want to buy the break. So say this is the break, it breaks. The liquidity is executed. All of this is so much liquidity in the market. What they do is manipulate price towards this point. So they spend, let's say, $5 million to get up to here so they could sell, fill all of this liquidity, and make $10 million. Same way going down. Manipulate the price, it pushes through, triggers a little liquidity. Now they have enough liquidity to fill their market order because they're trading very, very big. Boom, get fucked. You got first 5 minute opening range candle. This is after 9:30, so 9:35. This is the first 5 minute. And you got the 15-minute opening range candle, 9:45. What is this? Liquidity. What is this? Liquidity. So when it breaks this, are you gonna buy? Fuck no. You're gonna either wait for a rejection candle that looks like this and a confirmation candle after that, or you're gonna wait for the pullback. You see it broke the liquidity, the high liquidity, it broke. Now pulled back, but you see this wick, that means buyers are stepping in a long lower wick. Then you have more confirmation, then you can buy. Then there it goes, up. Same way down, exact same for the 15-minute. This is called a retracement and a rejection. You don't buy this candle, you buy, I usually buy at the close of this candle. That is what I recommend. Next is pre-market or overnight market. If you're trading US market, London session, Asia session, this is how you can find liquidity points. And these points are for you to notice and say, this is where I'm gonna get out of my trade at where you see the most wicks touch. If you look on the market, you will see wicks touching throughout the day, throughout the overnight market, throughout the pre-market. That's liquidity. So the institutions most likely will target this liquidity. Therefore, you can know your exit. I explained it as stupid as possible. A fifth grader can understand this. You're welcome.